Okay, thank you for the presentation. Along with Talal and Givi, my name is Daniela. We are going to discuss a bit your presentation, but as well the papers that we were provided for it. We were provided 2 reports, and we are going to focus mainly on these reports, but also it was super great to hear about the work that is being done by the institution. So here's a bit of the structure. We are going to first briefly summarize what you presented and also a bit of the logic of the reports. And then each of us is going to provide like a point for discussion. Briefly, the summary, we were provided 2 reports, and the 2 of them are kind of like the continuation of each other. And mainly they have like these aspects that we also heard in the last part of the presentation. They are calling for new approaches, and this is mainly criticizing the way that economic models are being done in a more conventional way, and how are they using like quadratic damage functions and everything. We're going to dive deeper into a part of the discussion. Also, we have something regarding the European Union's one-off scenario analysis. And not going so much into detail of this, but it's calling also this part of like the short-term logic that they have, and also the quantification of what is called stranded assets. And then we also have the introduction of macroprudential tools of what is like a suggestion to put into macroprudential regulation. And we're going to discuss a bit about the mechanism that they present. Gigi is going to explain a bit the rationality of the loan-to-value approach. And then we have like this very important contribution that we consider that Finance Watch is doing like an institution, because they are basically emphasizing how urgent is to pay attention to climate risk, and that so far we're being very passive regarding how we address the link between financial stability and climate risk.
Okay, so the main rationale behind the proposed prudential tools that I'm going to explain more in detail is that the only way to make private financial institutions take into consideration the public interest. The public interest in this case is to reduce the climate finance, to then reduce the financial instabilities that will be caused by climate change, is for 2 public authorities to enact the rules that will force private actors to change their behavior. In these 2 papers, there is 2 different prudential tools that is suggested. In the first paper, which is from 2020, they propose to calibrate the weight risks, which means that for already existing fuel reserves, it will be a weight risk of 150% to finance the already existing fuel reserves. And for the new fuel reserves, which are not explored yet, it will have a weight risk of 1250%, which could have potentially resulted in that for banks it would become incredibly expensive, unaffordable to finance the fossil fuels, and it would totally shift to a equity funding. And in the second paper, they suggest an LTV tool to establish a threshold based on the proportion of fossil fuel reserves that can be exploited within the remaining global budgets for a specific temperature of target, which is 2 Celsius. Okay, and just really broadly, what are some risks and unintended consequences? That is not only about these 2 papers, but overall to a financial regulation in the debate of climate change. Firstly, it's that favoring green and penalizing brown assets can increase the volatility, potentially leading to a financial instability. And the second risk could be that due to the reasons that clean energy technologies are capital intensive, they are technology intensive compared to fossil fuels. Their demand is proposed could increase, according to World Bank, could quadruple by 2050 to meet Paris agreements. And rising prices suggest a new commodity supercycle, but supply chain dependencies, limited substitutes, and geographic concentration could create a economic volatility that would reach also would go beyond the financial systems. Going to the first critique that we found is that is about secrecy and subsidiaries. What we mean by secrecy is secrecy jurisdictions, which are countries or territories that enable individuals or firms to hide their finances from the laws and regulations of other countries. And the main characteristic of secrecy jurisdiction is the regulatory framework that allows secrecy about critical details. So companies can basically hide some critical information, like true owners, and it's estimated that approximately 68% of fossil fuel financing by the world's 60 largest banks are directed to subsidiaries in secrecy jurisdictions, and this makes it really difficult to trace the finances and also difficult to quantify banks through fossil fuel exposure, which is also connected to the suggestion of prudential regulation in these two papers. Going into subsidiaries, I think this is a great example of how subsidiaries can make these regulations less effective. So, for example, Deutsche Bank Germany must report to the German Central Bank any loan that is granted to itself, by itself or by its EU subsidiaries. But if a loan is granted by US-based subsidiaries, it is not reported. So, especially in the framework of in the first paper of calibrating the risk weights, this would be effective in EU from the EU subsidiary of German company, but not to its subsidiary outside of EU boundaries. And there is also a 2 case study about how Aramco and Glencore's financial structures make it incredibly hard to identify all subsidiaries relevant to financing structures, even though it's in EU jurisdiction. Exploiting financial secrecy can enable fossil fuel companies to secure more favorable financing conditions. In the table, you can see that in the yellow, it's a bank's annual report about a fossil exposure, and in the blue, it is a report by, okay, I cannot see perfect, Banking on Climate Chaos, and there is a huge mismatch, which could be explained that exclusion of bond issuance from reporting and their failure to account for the entire corporate group in the fossil fuel financing, and not only focusing on the ones that are in EU. Okay, and here also you can see the countries that have the highest financing of fossil fuels. The 4 highest are in secrecy jurisdictions. And okay, and finally, my question for discussion would be: to what extent does the secrecy jurisdictions and subsidiaries might impact the effectiveness of proposed tools, especially outside of EU, or just a subsidiary which is operating outside of EU? Yeah.
Okay, for my part of the discussion, we are going to dive back into one topic that is very broad into the reports, but it was also presented in what you were explaining to us. And I'll start with this quote that is: economic modeling is misleading us about the effects of climate change, which is a very strong statement. And this is mainly referring to mainstream or conventional models like the DICE Nordhaus model that is based on a quadratic damage function, or other type of models like DSGE or integrated assessment models that they have like these characteristics that we can see here. For example, they are based in like a Walrasian general equilibrium. They rely on the formalization of hypotheses and logical links, and they are highly susceptible to the called Lucas critique regarding economic, macroeconomic modeling and policy implementation. Although we completely agree that some models, especially mainstream models, are completely underestimated the negative outcomes of climate risk for financial instability and the economy in general, we would like to bring a perspective regarding how we model the ecological transition. For this, we will go back to the contribution of Souffron et al. That we had a seminar on this extensively, very recent. And he basically agrees also on the perspective that the models that are currently being used by the European Commission and other institutions are facing a lot of challenges regarding the environmental transition. He summarizes all these challenges in these 11 points that for time we are not going to dive deep on each of them, but they are basically also referring to the critics that are being brought by the Finance Watch report. And he says that although conventional and mainstream models do have like these challenges and they are definitely not addressing properly the ecological transition, there's other alternatives that we can see when it comes to modeling for environmental transition. And this is like alternative models that are already being done, and it's because the report emphasizes that modeling tools should implement like a new vision regarding how we assess climate risk. And there's many models that come from like a more alternative or a heterodox perspective that are already doing this. These are all models that are being developed or had already been put out by several authors. And in this table, Souffron et al., they kind of try to address whether these models are properly responded to the criticism. And you can see that many of these models, like for example, the William model, is successful in overcoming many of the critics. And also you have like the James models that is being done by the AFD team in France that is also very strong when it comes to assess ecological aspects. So in this sense, it's like, yeah, mainstream models are insufficient, but maybe we could use other modeling tools. Another aspect that is often brought up in the report is that models usually rely a lot into the approach, into the risk approach. And there is this notion that we have heard many times of transition risk and physical risk. And although it's true that models mainly focalize in this aspect, the report says like, yeah, we should focus on uncertainty when it comes to environmental transition, and models cannot properly measure or assert for what uncertainty is. But we have a big aspect here that is like from ecological macroeconomics, that is an emerging discipline right now. They have at the very core of their funding principles the fact that they rely on radical uncertainty. And you also mentioned in your presentation the aspect of double materiality. And we have the ecological macroeconomics, for example. They rely on the endogenous approach to money that is accounting for this feedback loop between financial instability and environmental degradation. And these ecological macroeconomics are using, according to the firms, modeling tools like stock flow consistent models, for example. And we also have from evolutionary economics and complexity science that, according to Monasterolo, are one fields that are using stock flow consistent models and also agent-based models. And they also account for uncertainty and how it relates to climate risk and the elaboration of policy within climate risk. And they mention especially that it's important to account for modeling tools, because when you take into consideration uncertainty within the models, you can account for the stabilizing feedback loops. That is one of the aspects that we were mentioning regarding double materiality. And also you can assess the presence of nonlinearities, and also the fact that you can account for the role of path dependency in policy implementation. I will just take water. It's a lot of talking. It's very hard. Okay, and now, since we brought all this aspect of how modeling can be really useful when it comes to approaching the environmental transition, and especially when we consider that there's like these alternative models, we can see that financial regulation, although it's a great step, and this macroprudential tool that Finance Watch is proposing, it's already trying to make a contribution on how we can approach the climate risk within financial instability. Recently, we had also another seminar with Schwartzman, and he also mentioned how much relevance we're giving to financial tools and monetary tools when it comes to environmental transition. And it's the fact that we cannot assume that they can do everything. So financial tools and financial regulation should be framed into a more comprehensive framework of policy implementation, and in this sense, it comes really to a post-Keynesian discussion of how important is monetary policy in comparison of fiscal policy, and how should we really implement and complement these two approaches. So in this sense, we would like to see, yeah, financial regulation is relevant, and it's super nice that we're doing steps toward moving for environmental transition, but it's not everything, and modeling can help to implement these more comprehensive policy scenarios. And I would like to finish with this phrase that is also taken by the contribution of Sufron. We need different type of macroeconomic models for different purposes, and no model can be all things to all people. Basically, models can answer two different questions, and in this sense, my question for the discussion is, do you think alternative models can be complemented to the Finance Watch framework as useful tools to properly integrate financial regulation into a more comprehensive approach for policy implementation in the context of the ecological transition?
This part of the critique is going to be a little bit more ambitious because we're talking about transitioning beyond the capitalist scene. And as highlighted by Georgescu Rogan, we referred to dependency on math or modeling in economics as the mathematical symbolism. The problem with that is that it leads to an epistemic fallacy trap, which means that we only recognize the things that can be quantified or the things that are observable in a way. The problem, it leaves out a lot of aspects, especially when we're analyzing something like nature and environment, because it has endless properties and characteristics, most of which are not observed and cannot be quantified. So a lot of the impact that could lead to disasters or catastrophes might not be encapsulated within these models. And yeah, moving to the second point. And the problem that arises from that is the economic valuation challenges, because usually valuation happens by assigning prices or weights to something or commodity. But in nature and environment, a lot of the factors and a lot of the elements inside cannot be quantified because they don't have use values and they don't have trade values at the same time. And taking like a classic example like clean air, it cannot be, yes, it has a use value, but cannot be quantified and cannot be traded at the same time. And same goes to endangered species, like some of the gorilla species right now. Moving forward from that environment and nature also has culture and moral meanings, and this also cannot be quantified in terms of price tags and weights. This could be more of a reductionist point of view and leads to commensurability, which means that it could be easily substitutable or traded off by something else. And the last point related to also economic valuation challenges, that it frames nature using monetary values, as we've previously mentioned, and this leads to commodification, because yes, based on these models, it has huge price, but this price can be compensated, especially if we're talking about financial institutions, which are considered experts in terms of compensating the cost that they incur. So it's a heavy price, but also can be afforded by some institutions. And another point, it leads to the emergence of new markets or new business opportunities in order to incur these in order to compensate these losses, like expansioning in different territories that has maybe less regulatory restrictions, and this happens through global value chains, or maybe by doing some price adjustments, and this would compensate the losses for their exploratory endeavors in terms of extracting fossil fuels. And yeah, derivative markets like biodiversity bonds, or as like Elon Musk says, maybe populating Mars if things go worse. So yeah, we also recognize that modeling is important and it gives an overview about some aspects. And in order to have a policy discussion somehow, especially in Brussels, and as you mentioned previously, that we need to have some compromise and a middle ground. But it's just the problem that, especially when it comes to nature and environment, it's somehow considered invaluable. And when you have a discussion about giving it value and giving it a price tag, this is where the conversation goes to another discourse. So the question for this part would be, is it possible to find a method of assessment or analysis that might not fall under the capitalist scene theme? And these are the totality of our discussion questions, and we've added also some references in terms anyone want to expound on this research. Thank you for your attention.
answers, and then we give the floor to the other students. Okay.
Thanks. So thanks a lot. Really good reflections, and I'm not expecting to solve all the problems you raise right now. So disclaimer up front. But maybe to give some background to some of the points you raised, questions you raised, like what we thought about already on those points, what we've already discussed, and maybe some of the things the questions point to hit a brick wall, which I'll come to, basically, a current brick wall, which is not to do with the intellectual validity of the arguments you present, but just our current political reality. Yeah. So I think, on a couple of the points that were raised initially, and I think to go back to the first part of the discussion, we have this heavy reliance in the thinking of financial institutions and the way they apply regulation, how that kind of moves together to rely on historic performance, because they tend to rely on credit ratings, both the regulatory systems and the thinking of financial institutions. And that tends to be a kind of a way to kind of reassure yourself that everything is okay, both from a compliance point of view. You rely on something which it's not entirely your own work, so you can blame it on someone else if things go wrong, so it's a contingency, but it's also a way of thinking and a way of working, which is ingrained into the financial industry and into regulation, which makes any sort of maneuver difficult, any change difficult. So I think one typically, just trying to look at my notes here that I've written, but typically this idea of the secrecy and kind of moving to different jurisdictions, so where will there be less visibility? One of the key arguments that we get from the financial industry, I would say sort of in the corridors, not in the seminars, would be something along the lines of, we as an industry, as an EU banking industry, as an EU insurance industry, could bear the cost of increased weights, or we could clean our balance sheets. We're not too concerned about cleaning our balance sheets, at least the parts of the balance sheets that you see, of fossil fuel assets. Because anyway, at least up until now, there's been public pressure, there's been, I would say, pressure for their credibility in the face of their investors, in the face of their consumers. So there's been a public pressure, which would anyway act as a big incentive, maybe a bigger incentive to some extent than regulation, potentially. And so one of their key arguments is that in the short term, all these measures will do is push investment, or most of the investment and the benefits of this investment into private wealth funds, and these kinds of jurisdictions that you mentioned where there's less transparency. From our point of view, whilst it might be true, it's not a good reason to suggest that you shouldn't properly manage the risk. And I think this comes then very nicely to sort of having a more comprehensive view of policy making for the transition, for how we want to move our economy, how we want to regulate our economy, that was mentioned in the second area for discussion in a different context, but it comes together. And our point of view is, first of all, we're not as Finance Watch and as an organization, we're not able or experts to give that full perspective, but what we can do and what our role is to do is to say how risk management should be done properly, at least how you should apply the rules that are there within the same logic consistently and coherently. So that's one thing, and that would apply from our point of view with the calculation of fossil fuel assets and the fact, just going back simply to say that the credit ratings that are offered by admission of the agencies themselves, if you talk to them again in the corridors, are insufficient, underpricing the risk. So to look at that and say, well, that needs correcting, but that doesn't mean that the framework itself and the way we regulate doesn't need to change. So it's not a perfect answer. How do you kind of mitigate these less transparent, less well-regulated areas? It's a societal problem, I would say at the moment, and where that materializes most visibly, concretely, is tax. Probably more so even than financial regulation. We effectively legitimize a way for financial institutions, but also individuals with wealth, to bypass rules. That's done in a very clearly documented way. One small way we can try to mitigate that when it would come to our little part of regulation that we deal with at Finance Watch, financial stability, would be to increase the role of international supervisory bodies and authorities. So the way the banking committee, the Basel Banking Committee works is with peer reviews. And we can use those peer reviews, we could try to strengthen them, we could try to apply more pressure. And the result of the peer reviews would be that if jurisdictions are found through these reviews not to be implementing the financial stability rules properly, the framework properly, de facto the organizations operating through them and assets operating through them are subject to higher capital requirements, so they effectively are penalized. So this could be one way, fully acknowledging the limits and the fact that, although rather depressing, we're probably not going to see any huge changes and continued use of these kinds of jurisdictions for the foreseeable future. So, economic modeling, the very easy answer to the question is yes. It's not no, it's yes, but I think the point that we're trying to raise, rather than necessarily saying, I mean, we're just trying to show policymakers in particular with this report that economic modeling and the way it's being represented at the moment and the way it's being talked about by supervisors and used when they run climate scenarios is giving the impression, and they are giving the impression, that we're on a fairly safe path and that there's not, at the current stage, next year, within the next 5 years, important 5 years, regulatory electoral cycles, likely to be anything too crazy happening when it comes to climate. This is the message being given, at least publicly. This is the main issue that we have with the way that these models are used and the way the results are presented. Yes, I mean, I think it's well documented the limitations of Nordhaus, why that's limited. I think alternative models can really help to demonstrate that. But that's what they would be used for, I think, demonstrating the limitations of existing models, because they're so ingrained, and the investment needed to run models is also a key factor which we don't really talk about. This is something a little, confidential to an extent, but probably not to the extent that we can't share. But one of the limits of the modeling that's done by organizations like NGFS is just simply the cost of the modeling that's done. If they were to expand to the use of different models, expand the use of those models, the investment needed to do so would be so high that at the moment they just simply don't have it. So concerns that are practical, maybe again going to should we have a more comprehensive approach? Should we see where we need to invest more in the modeling? Should we see where we need to combine different types of regulation? What are the limitations? Unfortunately, they're all hitting that brick wall of, at the moment, we don't want to give supervisors more capacity, more resources. We're saying, from the financial industry side, much rather no. They've gone beyond their boundaries, they're doing too far, they're already not doing the work that we think that they should be. They shouldn't be looking into this problem further. So that's probably a no from their point of view, as should we look into alternative models and challenge what we have. It's a no from the supervisor if they don't have the resources to invest in that work. And also, politically, it's anyway a no that will implement it or listen to it at the moment. And that's probably the most important no, is that at the moment we're looking at how we can unpick this agenda for political reasons. And so the question would probably be, in the next 5 years, can we expect to have any positive regulation which will come from this commission, this EU political mandate, or how far will we unpick the Green Deal, the Sustainable Finance Framework and Stability Regulation that we've put in already, rather than can we have a more comprehensive approach, which I think we would definitely need in order to better capture climate risk, but also understand how we should regulate for the transition. And I think there a lot of interesting discussions come into play between public and private finance in particular. One topic, one exception to where that might be on the table for discussion is what we would call the nat cat protection gap for insurance in particular, the natural catastrophe protection gap, where the political pressure that comes from uninsured losses is so high and so visible with things like the California fires recently, but other floods, fires that happen in Europe every year, that it does create a political pressure to do something and to see how there would be some sort of combined public-private finance solution. Here we're talking about partnerships. It covers, I mean, without going perhaps too much into details in the 15 minutes now, but talking about taking the logic of what we had for things like terrorism pools, so pooling some public money to provide a minimum guarantee with private insurers who can take a profit from it. You have to ask yourself the question, though, from a double materiality point of view, probably, how far do you want governments subsidizing schemes with public money that companies are taking a profit from, which are then also being invested back into the fossil fuel industries, which are contributing to the same problem? So I think there's a moral hazard issue there which would need to be addressed. So, final question. This is one for you guys to answer, not for me, I feel, but you're the ones doing the master on this issue. I don't know. I don't know is the very honest answer. I agree with some of your analysis, but I don't know. And probably the political reality, which the thing I can speak to the most is no. Unfortunately, a very clear no. Yeah, I'd rather, maybe react to what you guys have to say on that discussion question, because I don't know.
Thanks for the discussion from the discussants and also for your talk. Friederike from Germany. I am going to be mean and ask two questions. The first is about the Capital Markets Union and the stuff you talked about regarding insurance. Because I did a little bit of work on the Capital Markets Union, and it seems like it's really like the big narrative, oh, like they're all going to finance it. How do you see it, like specifically within insurance, because it's also your specialty, if you could just say something on this. And the other one is more strategic. Because you work together with a lot of other think tanks and you have these platforms and everything, what would you say are the challenges there? Because I imagine every think tank also has their own agenda and like their own priorities also based on their funding. So maybe you could just see a little bit where you see some challenges and opportunities there.
Hi, thank you for your talk. I'm Thomas from Norway. I want to ask a bit about this competitiveness argument that you talked about that's in the wind at the moment, and exactly why are everyone so convinced of this argument, basically? Or what? Okay, first, what does the competitiveness of the financial sector mean? Competitiveness in which markets are you talking about? And because in the Draghi report, he's talking about that European banks have to be bigger and more profitable and have more to give more investment to the real sector, so that the real sector can be more competitive. But what they mean by the competitiveness of the financial sector, like in international markets, and why would we want to have this competitiveness, or why is everyone so convinced that this is it's a good thing to have big and profitable banks?
Thanks for your talk, also from my side. I'm Sarah, also from Germany, and I would like to come back to the question of how to adequately model climate risk. And what I was wondering from your interactions with also industry professionals and the entire EU bubble is whether you would say there is a more or less shared perception of the problem, like, do finance professionals see asset stranding as a large issue like you would do, or is there more a sense of maybe the transition isn't going to happen at all, or isn't going to happen with the right ambition, so we can keep exploiting all those fossil assets?
Thanks. Insurance and CMU, which is changing to the issue. I don't think they meant it to sound like that, but the Investment and Savings Union is, I mean, it's been a project to try to increase or kind of mobilize retail investors' savings, so people's savings, into European equity, right? And this is very much linked to the question of competitiveness. So the idea between both of these things is very linked. The idea being that a lot of European equity or good European businesses end up kind of being sold or financed from US capital markets. And that financing beyond a certain level mostly would come from the US capital markets, meaning that US investors are kind of getting the returns from the most successful European equity, basically. So this is kind of like the idea of competitiveness, and the CMU is to say, well, we have a lot of, and a lot is relative, but a lot of EU citizens, so retail capital, which is not being used as well as it should be. We also have a huge problem with pensions, retirement savings. And so if we could find a matchup between those kind of savings not being just held in bank accounts or in guaranteed products with very low returns, where the guarantee might be very expensive because the financial industry is trying to have very secure investments to be able to deliver on it, just in government bonds or something like that. So to try and say, can we have a better matchup between the like normal people's savings and break that link where European equity, successful European equity, is financed through American capital markets, have it financed through EU capital markets instead. So this is the concept. The reality of whether or not that's going to happen may be a little bit more complicated, a little bit more difficult, also because the member states, the biggest, anyway, obstacle to all of this, the member states don't agree on how it should happen. So very different views, very different ways to do that. A very basic example, which is referred to in the reports, is insolvency regulations. So just how different companies could be insolvent, how that might make it much easier to assess the kind of the investment propositions you might have across Europe, and whether or not we would harmonize that. Still hasn't been harmonized. Member states still won't agree. Competitiveness kind of goes much further beyond that as well now, and it's being used or kind of repurposed, I would say, by the financial industry to talk about deregulation. Why? Because of Trump coming into power, and Elon Musk and them talking very concretely about deregulation, about not applying international standards. Also because the City of London, closest competitor, has also probably traditionally, but also now concretely pushed forward this kind of slight kind of, not exactly race to the bottom, but just slightly lower application of rules, slightly more flexibility to gain a competitive advantage. But as I mentioned earlier, the question is, what are you competing with and what's the risk of the competition? Because if there were only upsides and benefits, why not? But the financial stability rules that they're talking about reducing, or the disclosure requirements which they're talking about abolishing, have a value to society, and that is to protect citizens from the risk of financial crisis or from losses through those companies which can take on shocks, effects and impacts, and eventually lead to the taxpayer having to bail out financial institutions. We know, and we've seen over the last years, that although we have now frameworks in place which should mean that taxpayers' money is not used to bail out financial institutions, it's still the first choice of governments because of the stigma that would be attached to using the European funds which would be available to bail them out otherwise. So you still have a risk that that will be bypassed and that that won't happen. And I think it's worth bearing in mind. Insurance specifically, it's interesting that insurers are so concerned about competition. In the US, they are not in the same situation as banks because insurers are subject to state-level regulation. So I'm not sure. Don't think there's any one insurer which operates across the whole of the US because they have to be authorized at each state level and have very different requirements for that reason. It also means that there's not so many EU insurers, European insurers, which are kind of tackling or in those markets, in the US market, across the US market. So when the insurers are talking about competitiveness, I think they're a little bit also jumping on the bandwagon. They're also looking at how they can increase profitability in a world where risks are getting more expensive. And because that is a reality, physical risks are increasing, particularly due to climate change and other things. Insurers are operating in a more expensive world from their point of view, with higher claims, higher losses likely to be on the table. Here, big societal debate also coming up, not really as part of the CMU, but also as part of the natural catastrophe protection gap that we spoke about. Also, the pensions protection gap is how do you manage those risks? And if you have a private industry profiting from covering those risks and providing that risk cover for society, I mean, within what parameters? And I think that's where we're talking now. And how far should that be? How far should public authorities have a control over that or participate in it? And that's this public-private kind of debate that's happening. And it goes beyond simply the insurance schemes, but also into who should pay for relocating buildings in flood zones, or should we have different kinds of planning permission? What mitigation measures should we take in areas that would be subject to rising sea levels, etc. So big societal debates, and the same when it comes to pensions, a key topic in the Investment Savings Union and CMU. We're saying we don't have the capacity with changing demographics in populations to cover retirement income for everybody. At the moment, probably most of us, maybe some of you even less than me, could expect 40% perhaps of what your final salary was as your retirement income, which is a very, very different style of life to what you would have had with that final salary. A good replacement sort of final salary is expected to be something like 70% of your last retirement income. And the suggestion at the moment is that you invest in European equity. So hopefully there won't be a financial crisis.
Hi, my name is Marie-Noël. I'm from Germany. And I had a thought, or like a question that came up from the last week's presentation by Romain Schwarzman on the role of central banking. And I guess you don't do so much monetary policy because it's not in the same policy making framework that you showed in the tube. But there, inside the literature, there's a view that ask for a more proactive role of the central banks and would not only require banks to have different capital requirements according to the fossil assets, but also a proactive role of the central bank via purchasing green bonds, for instance, or setting different interest rates, etc. And that made me think about that at the beginning you said you don't go to policymakers and ask for something, but you're just like, use the opportunity when there's something very concrete going on. And I was wondering, how you have those internal discussions about what is strategic to ask for something maybe bigger to like also steer the narrative into a direction, or if it's only really what is strategic to be within the frame or within the window of opportunities that is possible, or strategic to like not be strategic. That was my question. So what else?
Who else? So, do a question myself. I'm studying here in Paris. I'm here for 1 year, and I'm studying the central bank digital currencies. And then I got interested when you said that, well, there are hot discussions being held in Brussels about the digital euro. So if you can explore it a bit further on the agents which are strongly opposing to that and those who are in favor, and how are those struggles happening, then I would be happy to listen. Thank you.
Thanks. Happy to look at digital euro. So what you're talking about, the Overton window of like what can be discussed in policy making, why do we operate mainly in that Overton window rather than try to shift the window? I mean, it's an interesting question, and it probably, the background to it is the question which I realized I didn't yet answer on whether or not there's a shared perception of the problem in Brussels. I think the Brussels bubble could probably is a little bubble in the sense that you could easily sort of convince yourself that you're doing the best you can. I think there is probably a tendency to rely on the scenarios that are called normal scenarios, not the scenarios that are called extreme scenarios when it comes to climate change, which are probably the more realistic scenarios. There's a tendency to believe and kind of either hope, and sometimes that's with people using terms like I'm an optimist when it comes to discussions about impact of climate risk, but a tendency to kind of believe that there will, or enough has been done and the market will be able to direct the financing where it needs to go with the level of regulation or with reduced regulation, that there's enough willingness and enough capacity. The regulation that's there is more of a burden than anything else. So I think that's probably the prevailing view. And it goes back to the point of why we think that there should always be a reality check or a disclaimer with any economic modeling that's used behind assessment of climate risk. And the disclaimer would just be, how does it match up to what climate science is delivering right now in terms of pathways, in terms of concrete impacts? Does the control of the model, does it make sense within that context? You know, does it match up to reality? The reality check of it is important, and to make that reality check extremely clear to policymakers who don't have the capacity, time, or maybe willingness to look at the models, but who use them to justify policy measures that are also compatible with them potentially being re-elected in 5 years. On the digital euro, I should put you in contact with my colleague Peter, who's working closely on this, but it's a difficult debate, and I think there's a risk that we will be going back to zero in the legislative process in Brussels because it's been so contentious and because the political groups don't agree. But I think a lot of the discussion is over how you would distribute this digital euro. So we have existing payment services providers who have a very keen interest in distributing, and we link the discussion, I think, very often as well to the discussion around open finance in general and being able to have access to services and a look through with providers that aren't necessarily the company where your assets are held, if that makes sense. So using that kind of, combining those two things, I think one of the main concerns that we also have, like very practical concerns with some of the organizations we work with on social inclusion as well, is just still to kind of take that little step back and just also bring in those exclusion perspectives that we still have, and it's not always visible to us. I mean, a lot of devices in the room, but there are still significant numbers of EU citizens who don't have access to digital tools. We already see reductions in their capacity to access cash, their reliance on cash. Sometimes it's older people, sometimes it's people on lower income situations, but just it's sometimes easy to forget how important access to digital tools is to those who don't have them and how much it can bring. And so the idea that a digital euro could bring more inclusion from some perspectives, but might cause exclusion from other perspectives and drive a situation where a reliance on cash or cash is abolished is also something that we need to consider. Yeah.
Hello, thank you for presentation. I'm Zulfia from Azerbaijan. I wanted to ask you the question about stranded assets, especially for fossil fuels, because I've read a lot about like articles and like research papers about this, but for me the unclear part, maybe it's a bit, I don't know, stupid question, but like as we know that like technology suppliers of fossil fuels and like who demands fossil fuels are mostly Western countries, core countries, and these countries are the ones also who impose the climate change policies and are forced to drive all other countries to follow up. So like is unexpected strandification of fossil fuel assets possible because both drivers come from one side, and is this uncoordination possible? Like, can you explain like how it would happen if it happens?
Thank you. I'm Arthur from the Netherlands, and I was wondering, when you mentioned shortly in your presentation something about the way in which you received finance as NGO yourself, that also some money was coming from one of the DGs. And there was a small scandal in the Netherlands where I was following the news about the fact that Frans Timmermans, the former Minister of the Green Deal, that he would be funding his own green lobbyist in Brussels. And I was just wondering, what is your view on sort of like the balance of power between the NGOs and the lobbyists from the banking industry? Because the main defense in the news, at least, was from Frans Timmermans himself, that like you need sort of the balancing of NGOs in order to provide a counterweight in Brussels against the banking of the industry.
Thanks. Stranded assets, I mean, it goes a little bit back to the discussion question that we had on kind of jurisdictions where there's less rules, less requirements. But I mean, the assets, I think we're not only talking about assets held now by the EU, we're talking about the West in terms of US as well, right? And and the rules coming from there too. I think the closest we come to recognizing the limitations of that is in the COP process, when we talk about the need for more inclusion from affected communities. I think the only point where that really comes into our work, but is not at all considered in the regulatory process by regulators, by EU governments, is when we look at First Nations and peoples and the impacts that they have, and we try to inform the policy process and show that it goes beyond the kind of the impacts and the rules, or the impacts reach much further and materialize in a very different way to sort of how we talk about them, and also that that what we call, or the power structures around how those regulations are being created, and when we have the idea of consulting stakeholders and all interested parties, we're actually overlooking a huge part of the process and discussion. But I mean, more than that to comment on the dynamic. I mean, I see your point, but I don't. I think that's where we are. That's our reality. I mean, as I said, other than sort of opening that process up and trying to enable more participation, I don't see any other dynamic, and I see very little appetite from policymakers to think about it, to explore it, or politically to go near it at all. And then speaking of how politically sort of difficult the situation has become for NGOs, yes, I mean, I see the point of Mr. Timmermans. This is also a very concrete political priority of the European People's Party and some of the centre and far-right political parties, which has come through the elections and post-elections, European elections, which is to target the financing, the EU financing of NGOs. So Finance Watch is funded through a part of EU funds and also by philanthropy donations. The part of the EU funding that we have includes representing the public interest in policy making, so it's a similar kind of debate and situation to the green NGOs who are getting funds from the LIFE program, if you like, similar dynamic. Our view is that it's extremely important to have civil society, so interests which are trying to represent the public interest and give a view of what that might be beyond policymakers themselves, who do, in theory, have that mandate to regulate in the public interest, but to have some more reach to different groups and to have them represented and their views represented in Brussels. So, yeah, surprise, surprise, we're agreeing that it's a good thing. But I think the perspective is, or to put it into context, the efficiency, resourcing, and reliance on the industry lobby is extremely high. And their priority is not the public interest, it's not supposed to be. Their accountability is to their shareholders and it's their profit margins, those private companies. That's what our society allows and agrees to, so we shouldn't expect them to inform policymakers in the public interest. So from my perspective, it's a good idea if we do ensure that there is a counterbalance and a voice which has the technical expertise or expertise on topics which can provide that interest as well. And unfortunately, the only way that we can ensure that's the case is to finance it. I mean, fortunately, the reality is we need to finance it with some public money, because otherwise those organizations won't exist. They're not profit organizations. You're just paying for expertise and for further expertise. And you're also paying a much lower price than, and that's probably part of the logic of doing so, much lower price than you would be paying if you were paying for additional civil servants who would cost much more.